Question 1. Which of the following is a primary advantage of forming a captive insurance company? A. Captives can only provide health insurance coverage. B. Captives allow businesses to retain risks and reduce insurance premiums. C. Captives are subject to the same regulation as traditional insurance companies. D. Captives are always exempt from state premium taxes. Answer: B. Captives allow businesses to retain risks and reduce insurance premiums. Explanation: the primary advantage of forming a captive insurance company is that it allows businesses to retain risks within the company, which can result in lower overall insurance premiums. Captives give businesses the ability to tailor insurance coverage specifically to their needs while retaining underwriting profits that would otherwise go to an outside insurer. While captives can provide a variety of insurance coverages, including health insurance, this option is not a defining feature or advantage. Captives are regulated by the state but generally receive more flexible regulations than traditional insurers. Additionally, they are not automatically exempt from premium taxes. E.g., South Dakota's 0.5% premium tax rate applies to captives. Question 2. Scenario question: Mr. Thompson is considering forming a captive insurance company for his large manufacturing business. The company faces unique risks related to the specialized equipment it uses, and Mr. Thompson believes that a captive could provide more tailored coverage at a low cost than traditional insurance. He is also concerned about ensuring compliance with South Dakota's regulatory framework for captives. What is the first step Mr. Thompson should take in the formation of his captive insurance company? A. Submit an application for a captive license to the South Dakota Department of Insurance. B. Prepare the articles of incorporation and business plan for the captive. C. Arrange the necessary reinsurance agreements for the captive. D. Select an independent auditor to review the financial operations of the company. Answer: B. Prepare the articles of incorporation and business plan for the captive. Explanation: the first step in forming a captive insurance company is to prepare the articles of incorporation and a business plan for the captive. This includes outlining the company's purpose, capital structure, and the types of coverage the captive will provide. South Dakota's regulations require that a captive's business plan be submitted as part of the formation process to ensure it meets regulatory requirements and has a clear operational plan. After the business plan is in place, the next step would be applying for a captive license with the South Dakota Department of Insurance, followed by structuring reinsurance arrangements and engaging an auditor as needed. Question 3. What is a protected cell captive insurance structure? A. A captive that only provides medical malpractice coverage. B. A structure where multiple companies share a single captive insurance company, but each company's assets and liabilities are legally segregated. C. A reinsurance arrangement where the captive's risk is transferred to an external insurer. D. A captive that is not regulated by the South Dakota Department of Insurance. Answer: B. A structure where multiple companies share a single captive insurance company, but each company's assets and liabilities are legally segregated. Explanation: a protected cell captive allows multiple companies to form a single captive insurance company, but with segregated cells for each participant. Each cell is legally independent, meaning the assets and liabilities of one cell cannot be used to cover the risks or debts of another cell. This structure allows businesses to share the cost of the captive while maintaining legal separation of risks. This is different from traditional captives where all assets and liabilities are pooled together. Protected cell captives offer flexibility, making them an attractive option for companies seeking to manage risk while minimizing costs. It is also a structure regulated by the South Dakota Department of Insurance. Question 4. Which of the following is a key requirement for the formation of a captive insurance company in South Dakota? A. The company must have at least 50% of its premium income derived from non-affiliated parties. B. The company must maintain a minimum capital and surplus as outlined by the South Dakota Captive Insurance Company Act. C. The company must only provide reinsurance for risks covered by other captives. D. The company must be structured as a public entity under South Dakota law. Answer: B. The company must maintain a minimum capital and surplus as outlined by the South Dakota Captive Insurance Company Act. Explanation: the South Dakota Captive Insurance Company Act requires that captives maintain a minimum capital and surplus to ensure their financial stability. This requirement is designed to protect policyholders and ensure that captives can meet their obligations. South Dakota's law outlines the specific amount based on the type of captive being formed, such as pure captives or protected cell captives. While captives may derive income from both affiliated and non-affiliated parties, the key regulatory requirement is the minimum capital and surplus, not income diversification. Captives can provide a wide range of insurance coverages, not just reinsurance, and they are structured as private entities, not public entities. Question 5. Which of the following is true regarding the risk-based capital (RBC) requirements for South Dakota captive insurance companies? A. RBC requirements apply to captives that write primarily reinsurance business, but not to those writing direct insurance. B. RBC is determined based on a calculation of the captive's investment portfolio performance. C. RBC requirements are set by the South Dakota Department of Insurance and ensure captives maintain adequate reserves to cover future liabilities. D. RBC is only required for captives that issue policies to affiliated entities. Answer: C. RBC requirements are set by the South Dakota Department of Insurance and ensure captives maintain adequate reserves to cover future liabilities. Explanation: risk-based capital (RBC) requirements are a regulatory tool used to ensure that captives maintain adequate capital reserves to cover their future liabilities, considering the specific risks they assume. The RBC formula determined by the South Dakota Department of Insurance evaluates a captive's capital in relation to its risk profile. This includes both underwriting and investment risks, ensuring that captives have enough capital to remain solvent and meet policyholder claims. RBC is applicable to all captives, not just those dealing with affiliated entities, and is not limited to reinsurance businesses. The performance of the investment portfolio is part of the broader financial solvency review, but not the direct basis for RBC calculation. Question 6. What is the role of an actuary in a captive insurance company? A. To ensure compliance with tax reporting requirements for captives. B. To design the captive's governance structure and board of directors. C. To assess and manage the risks faced by the captive and provide pricing for insurance products. D. To handle the claims management process for the captive. Answer: C. To assess and manage the risks faced by the captive and provide pricing for insurance products. Explanation: actuaries play a crucial role in assessing and managing the risks faced by a captive insurance company. Their responsibilities include determining the appropriate pricing for the captive's insurance products based on the risks it assumes, including evaluating loss reserves and developing actuarial models. Actuaries ensure that the captive has adequate financial resources to cover future claims by accurately predicting claims experience and assessing risk. While actuaries may provide guidance on pricing and risk management, they do not design the governance structure, handle tax reporting, or directly manage claims. Question 7. Scenario question: Mr. Patel is the CEO of a large retail chain that is considering forming a captive insurance company to cover its workers' compensation risks. The company wants to ensure that it complies with both federal and state regulations and that it can benefit from potential tax advantages. What is Mr. Patel's best course of action before proceeding with the formation of the captive? A. Immediately submit an application for a captive license to the South Dakota Department of Insurance. B. Develop a detailed business plan, including a feasibility study, and submit it to the South Dakota Department of Insurance for approval. C. Arrange a fronting agreement with a large commercial insurer to handle all claims. D. Start paying premiums directly to the captive without forming the company first. Answer: B. Develop a detailed business plan, including a feasibility study, and submit it to the South Dakota Department of Insurance for approval. Explanation: before forming a captive insurance company, Mr. Patel must first develop a detailed business plan, which should include a feasibility study. The business plan must outline the risks to be covered, the financial structure, the capital requirements, and the projected claims experience. This plan is a critical part of the regulatory approval process in South Dakota. The South Dakota Department of Insurance will review the business plan to ensure that the captive can operate financially sound and comply with all applicable regulations. Simply submitting an application without a comprehensive plan or proceeding with premiums prematurely would not be compliant with regulatory requirements. Fronting agreements may be considered later, but are not the first step. Question 8. Which of the following statements about the taxation of South Dakota captives is correct? A. South Dakota captives are exempt from all federal income tax obligations. B. South Dakota captives are subject to the same tax rates as other South Dakota-based businesses. C. South Dakota captives that meet the criteria for Section 831. B. Captives may qualify for tax advantages, including deductions for premiums paid. D. South Dakota captives are not required to file tax returns if they have no taxable income. Answer: C. South Dakota captives that meet the criteria for Section 831. B. Captives may qualify for tax advantages, including deductions for premiums paid. Explanation. South Dakota captives that qualify under Section 831(b) of the Internal Revenue Code may benefit from tax advantages, such as deductions for premiums paid, which significantly reduces the taxable income of the captive. This section applies to small captives that meet certain criteria, such as writing no more than $2.4 million in premiums. These captives are taxed only on their investment income rather than their underwriting income. While South Dakota captives are subject to state premium taxes, they are not exempt from federal tax obligations. Additionally, captives must file tax returns even if they do not generate taxable income. Question 9. Which of the following best describes the concept of fronting and captive insurance? A. Fronting involves a captive purchasing insurance coverage from a traditional insurer to manage its risks. B. Fronting occurs when a captive assumes the underwriting risk for another insurer. C. Fronting is when a third-party insurer issues policies on behalf of the captive to meet regulatory requirements. D. Fronting means that a captive only writes reinsurance policies for other insurance companies. Answer. C. Fronting is when a third-party insurer issues policies on behalf of the captive to meet regulatory requirements. Explanation. Fronting refers to a practice where a traditional insurer issues policies on behalf of a captive insurance company to satisfy regulatory requirements, such as the need for an authorized insurer to issue policies. The fronting insurer assumes the legal responsibility for issuing the policy, but the captive ultimately assumes the risks and liabilities. This arrangement is often used when captives are not yet licensed to issue policies on their own, or when certain jurisdictions require a licensed insurer to issue policies. The fronting insurer typically retains a fee, and the captive reimburses the insurer for the claims or risks assumed. Question 10. Which of the following is not a type of captive insurance company recognized under South Dakota law? A. Pure captive insurance company. B. Group captive insurance company. C. Risk retention group. D. Protected cell captive insurance company. Answer. C. Risk retention group. Explanation. South Dakota law recognizes several types of captives, including pure captives, group captives, and protected cell captives. However, a risk retention group is a distinct legal entity under federal law, and while South Dakota allows risk retention groups to operate in the state, they are not classified as captives under South Dakota's specific regulations. Question 11. Which of the following factors most likely contributes to the viability of a South Dakota captive insurance company? A. The ability to offer unlimited policy limits on all types of coverage. B. The use of advanced risk management techniques and cost savings. C. Having all premiums funded by the captive's parent company only. D. The captive's investment portfolio being limited to stocks and bonds. Answer. B. The use of advanced risk management techniques and cost savings. Explanation. The viability of a captive insurance company depends heavily on its ability to manage risks efficiently and achieve cost savings for its parent company. This includes using advanced risk management techniques such as loss prevention programs, claims management, and pricing strategies, while having a parent company fund premiums or limiting investments to stocks and bonds may affect a captive's financial strategy. The core factor contributing to the long-term success of a captive is its risk management and cost-saving effectiveness. Question 12. What is the minimum required surplus for a South Dakota captive insurance company to maintain in order to remain solvent? A. $250,000. B. $500,000. C. $1 million. D. $2 million. Answer. B. $500,000. Explanation. According to South Dakota law, the minimum required surplus for a captive insurance company is typically $500,000, although the amount may vary depending on the type and size of the captive. This surplus ensures that the captive has adequate financial resources to cover its liabilities and meet solvency requirements. Question 13. Which of the following is a key benefit for a company forming a captive insurance company in South Dakota? A. Captives are exempt from state premium taxes. B. Captives may offer more flexible policy terms than traditional insurers. C. Captives can only insure risks that are unrelated to the parent company's business. D. Captives are required to have a large number of unrelated insureds for regulatory approval. Answer. B. Captives may offer more flexible policy terms than traditional insurers. Explanation. One of the key benefits of forming a captive insurance company is the ability to customize insurance policies to better suit the needs of the parent company. Captives can offer more flexible terms, coverage limits, and risk management strategies than traditional insurers. They are not required to cover unrelated risks, and while premium taxes may apply, they are often lower than those for traditional insurance companies. Additionally, captives are not required to have large numbers of unrelated insureds. Question 14. Scenario question. A South Dakota-based captive insurance company is considering reinsuring part of its portfolio with an offshore reinsurer to reduce capital requirements. What is the most important consideration for the captive in making this decision? A. Ensuring that the offshore reinsurer is rated by a major rating agency. B. The potential for tax advantages by using an offshore reinsurer. C. Ensuring the offshore reinsurer complies with South Dakota's financial solvency requirements. D. The offshore reinsurer's ability to write more policies than the captive. Answer: C. Ensuring the offshore reinsurer complies with South Dakota's financial solvency requirements. Explanation: when a South Dakota-based captive reinsures with an offshore reinsurer, the most critical factor is ensuring that the offshore reinsurer complies with the financial solvency requirements set forth by South Dakota law. This helps to guarantee that the reinsurer has the financial strength to pay claims if necessary. While tax advantages and ratings may also be considered, compliance with solvency regulations is paramount to protect the captive's policyholders and ensure long-term stability. Question 15. Which of the following is not the common purpose of a captive insurance company? A. Reducing overall insurance costs for the parent company. B. Providing insurance coverage to unrelated third parties. C. Offering customized insurance products for the parent company. D. Retaining underwriting profits within the parent company. Answer: B. Providing insurance coverage to unrelated third parties. Explanation: captive insurance companies are typically formed to provide coverage for the risks of the parent company and its affiliates, not for unrelated third parties. The primary purposes of a captive include reducing insurance costs, offering tailored coverage, and retaining underwriting profits within the parent company. While captives can occasionally offer insurance to affiliated entities, providing coverage to unrelated third parties is not a typical use. Question 16. Which of the following is not a required element in the business plan for a South Dakota captive insurance company? A. The types of coverage the captive will provide. B. A risk management plan for addressing the captive's underwriting risks. C. The amount of premiums the captive expects to write annually. D. A detailed list of all employees the captive plans to hire. Answer: D. A detailed list of all employees the captive plans to hire. Explanation: the business plan for a South Dakota captive insurance company must include elements such as the types of coverage the captive will provide, a risk management plan, and an estimate of the premiums expected to be written. However, a detailed list of employees is not a required component of the business plan. While the plan may outline staffing needs, it is more focused on the operational and financial aspects of the captive. Question 17. What is a primary factor that South Dakota regulators consider when approving a captive insurance company's business plan? A. The reputation of the captive's management team. B. The number of unrelated insureds the captive plans to cover. C. The solvency and capital structure of the captive. D. The geographic location of the captive's parent company. Answer: C. The solvency and capital structure of the captive. Explanation: when South Dakota regulators review a captive insurance company's business plan, they focus primarily on the solvency and capital structure of the company. This ensures that the captive will have the financial resources to meet its obligations and cover the risks it assumes. While the reputation of the management team and other factors may be considered, solvency and capital adequacy are key regulatory priorities. Question 18. What is the primary function of a captive insurance company's board of directors? A. To handle the daily operations of the captive insurance company. B. To provide strategic oversight and ensure the captive's compliance with regulatory requirements. C. To manage claims and policyholder relations. D. To market the captive's products to external parties. Answer: B. To provide strategic oversight and ensure the captive's compliance with regulatory requirements. Explanation: the primary function of the board of directors of a captive insurance company is to provide strategic oversight and ensure that the captive complies with regulatory requirements. The board is responsible for setting policy, approving financial decisions, and ensuring that the captive meets legal and regulatory obligations. Daily operations and claims management are typically handled by the captive's management team, not the board. Question 19. Which of the following is a required filing for a South Dakota captive insurance company? A. A biannual report detailing the captive's investments and claims. B. An annual financial statement certified by an independent auditor. C. A quarterly report detailing the premiums written by the captive. D. A filing of claims data with the South Dakota Insurance Guarantee Fund. Answer: B. An annual financial statement certified by an independent auditor. Explanation: South Dakota requires their captive insurance companies submit an annual financial statement that has been certified by an independent auditor. This ensures that the company is financially sound and capable of meeting its obligations. While other filings may be required, the annual audited financial statement is a critical regulatory requirement for captives. Question 20. In South Dakota, what type of insurance premium tax is imposed on captives? A. A flat rate tax on all premiums written by the captive. B. A tax based on the amount of premiums the captive collects from unrelated third parties. C. A graduated tax rate based on the captive's net income. D. A tax based on the amount of premiums written with a cap for captives that meet certain criteria. Answer: D. A tax based on the amount of premiums written with a cap for captives that meet certain criteria. Explanation: South Dakota imposes a premium tax on captives based on the amount of premiums written, with the rate generally being lower than that of traditional insurance companies. Captives that meet certain criteria, such as writing premiums exclusively for affiliated entities, may qualify for a cap on the tax rate. This system is designed to provide financial incentives for captives to operate in the state. Question 21. What is a protected cell in the context of a South Dakota captive insurance company? A. A separate legal entity acts independently from the parent company. B. A part of the captive where assets and liabilities are segregated for each policyholder. C. A section of the captive used for investment purposes only. D. A special class of insurance products designed for unrelated third parties. Answer: B. A part of the captive where assets and liabilities are segregated for each policyholder. Explanation: a protected cell is a separate account within a captive insurance company where the assets and liabilities are segregated for specific policyholders or groups of policies. This structure allows different risk portfolios to be isolated from each other, protecting the assets of one cell from liabilities of another. It does not create a separate legal entity. Question 22. Which of the following statements about South Dakota's captive insurance industry is true? A. South Dakota only allows pure captives and does not allow group or association captives. B. South Dakota has become a leading domicile for captive insurance due to its favorable regulatory environment and tax policies. C. South Dakota imposes a higher premium tax on captives than most other states. D. Captives in South Dakota are restricted from reinsuring risks outside of the state. Answer: B. South Dakota has become a leading domicile for captive insurance due to its favorable regulatory environment and tax policies. Explanation: South Dakota is considered one of the leading domiciles for captive insurance due to its favorable regulatory environment, competitive tax structure, and flexibility in terms of the types of captives it allows. The state offers a business-friendly framework that makes it attractive for companies seeking to form captive insurance companies. Question 23. Which of the following is a benefit of establishing a captive insurance company in South Dakota? A. There is no oversight from the state's insurance regulators. B. Captives in South Dakota can deduct all premiums paid to third-party insurers from state taxes. C. South Dakota captives can invest in any type of asset without restrictions. D. Captives in South Dakota can receive regulatory approvals quickly and efficiently. Answer: D. Captives in South Dakota can receive regulatory approvals quickly and efficiently. Explanation: South Dakota is known for its efficient regulatory processes. The state's insurance department has streamlined procedures for forming captives, allowing businesses to receive regulatory approvals in a timely manner. This efficiency is one of the major benefits of establishing a captive in South Dakota. Question 24. What is the primary responsibility of the South Dakota Division of Insurance in relation to captive insurance companies? A. To set premiums for all insurance policies issued by captives. B. To monitor and ensure the financial solvency and regulatory compliance of captive insurance companies. C. To offer investment advice to captive insurance companies. D. To approve the business plans of captives but not to monitor their ongoing operations. Answer: B. To monitor and ensure the financial solvency and regulatory compliance of captive insurance companies. Explanation: the South Dakota Division of Insurance is responsible for overseeing captive insurance companies to ensure that they remain solvent and compliant with state regulations. This includes reviewing business plans, monitoring financial conditions, and ensuring that captives meet all legal and regulatory requirements. Question 25. Which of the following is a key factor that may determine whether a South Dakota captive insurance company is required to submit audited financial statements? A. The number of insured parties the captive covers. B. Whether the captive writes policies for affiliated companies only. C. The amount of premiums written by the captive in a given year. D. The geographical location of the captive's parent company. Answer: C. The amount of premiums written by the captive in a given year. Explanation: the requirement for submitting audited financial statements is typically tied to the amount of premiums written by the captive in a given year. Larger captives, particularly those writing substantial premiums, are generally required to submit audited financial statements to demonstrate their financial solvency and transparency. Question 26. Which of the following types of captives cannot be used to write insurance policies for unrelated third parties under South Dakota law? A. Pure captive. B. Group captive. C. Risk retention group. D. Protected cell captive. Answer: A. Pure captive. Explanation: a pure captive insurance company is created solely to insure the risks of its parent company and its affiliates. It cannot be used to write insurance for unrelated third parties. Other types of captives, such as group captives or risk retention groups, may be able to offer insurance to third parties under specific circumstances. Question 27. Which of the following best describes a group captive in South Dakota? A. A captive owned by a single entity that insures only the entity's risks. B. A captive formed by a group of businesses to collectively insure their risks. C. A captive that can only insure workers' compensation and liability risks. D. A captive with no regulatory oversight from the South Dakota Division of Insurance. Answer: B. A captive formed by a group of businesses to collectively insure their risks. Explanation: a group captive is formed when multiple companies, often with similar risks, come together to pool their resources and collectively insure those risks. This structure allows companies to share the cost of insurance while benefiting from the potential cost savings of a captive insurance program. Unlike a pure captive, a group captive is not limited to a single parent entity. Question 28. What is the maximum number of protected cells that a South Dakota captive insurance company can have? A. 10. B. 50. C. No limit. D. 100. Answer: C. No limit. Explanation: in South Dakota, there is no limit to the number of protected cells a captive insurance company can have. This flexibility allows captives to create as many cells as needed to segregate risks, assets, and liabilities for different groups or types of insurance coverage. Question 29. Which of the following is a regulatory requirement for a captive insurance company operating in South Dakota? A. The captive must provide insurance to third-party policyholders. B. The captive must maintain a minimum level of surplus to ensure solvency. C. The captive must be owned by at least 5 independent shareholders. D. The captive must insure risks from unrelated businesses. Answer: B. The captive must maintain a minimum level of surplus to ensure solvency. Explanation: one of the key regulatory requirements for captives in South Dakota is maintaining a minimum level of surplus to ensure the company's financial solvency. This is essential for ensuring that the captive can meet its claims obligations and remain financially stable. Question 30. A South Dakota-based captive insurance company is considering using reinsurance to manage its risk exposure. Which of the following is the most important consideration when selecting a reinsurance provider? A. The reinsurance provider's ability to offer lower premiums than competitors. B. The reinsurance provider's reputation and financial stability. C. The geographic location of the reinsurance provider. D. The number of unrelated third-party clients that the reinsurance provider serves. Answer: B. The reinsurance provider's reputation and financial stability. Explanation: the most important consideration when selecting a reinsurance provider is its reputation and financial stability. The reinsurer must have the financial strength to honor claims and provide the security needed to manage the captive's risks. While pricing and location may also be relevant, the financial security and stability of the reinsurer are paramount.